Portfolio diversification is a fundamental strategy for building a resilient investment portfolio. By spreading investments across different sectors and asset classes, investors can reduce exposure to individual stock risks and minimize the impact of market volatility. In this comprehensive guide, we'll explore the fundamental principles of portfolio diversification, its benefits, and how beginners can effectively implement this strategy to build a resilient investment portfolio. Understanding portfolio diversification. Portfolio diversification is based on the principle of not putting all your eggs in one basket. By spreading investments across various sectors, industries, and asset classes, investors aim to minimize the impact of a decline in any single investment on the overall portfolio. This strategy is designed to reduce the potential for significant losses that may result from the poor performance of a single investment. Benefits of portfolio diversification. The primary benefit of portfolio diversification is risk reduction. By investing in a variety of assets, investors can lower the overall risk of their portfolio. Additionally, diversification can lead to more stable returns over time, as losses in one area may be offset by gains in another. This strategy can also help investors take advantage of different market conditions and economic cycles, thereby enhancing the overall performance of the portfolio. Implementing portfolio diversification. For beginners, implementing portfolio diversification involves allocating investments across different asset classes, such as stocks, bonds, real estate, and commodities. Within the stock market, diversification extends to investing in various industry sectors, such as technology, healthcare, consumer goods, and finance. It's important to note that diversification should be based on a careful assessment of individual risk tolerance and investment goals. Asset allocation and risk management. Asset allocation is a key component of portfolio diversification. It involves deciding how to distribute investment capital among different asset classes, based on risk tolerance and investment objectives. By combining assets with different risk-return profiles, investors can create a balanced portfolio that aligns with their risk tolerance while aiming to achieve their financial goals. Rebalancing and monitoring. Regularly monitoring and rebalancing a diversified portfolio is essential. Market conditions and the performance of various asset classes can cause the original asset allocation to drift over time. Rebalancing involves adjusting the portfolio back to its target asset allocation. By staying vigilant and adaptable, investors can maintain the benefits of diversification and ensure that their portfolio remains aligned with their investment objectives. Achieving diversification. To achieve a diversified portfolio, look for asset classes that have low or negative correlations, so that if one moves down, the other tends to counteract it. Building a diversified portfolio is one of the reasons many investors turn to pooled investments such as mutual funds and exchange-traded funds. Pooled investments provide exposure to a wide range of assets within a single investment vehicle, enhancing diversification and risk management. Quick ways to build a diversified portfolio. One of the quickest ways to build a diversified portfolio is to invest in several stocks. A good rule of thumb is to own at least 25 different companies. Additionally, investors can consider investing in asset classes such as bonds, real estate, and commodities to further enhance diversification. Exchange-traded funds, ETFs, and mutual funds are also popular choices for diversifying across various sectors and asset classes. In conclusion, portfolio diversification is a fundamental strategy for building a resilient investment portfolio. By effectively implementing portfolio diversification, beginners can mitigate risk, enhance the stability of their investment portfolio, and work towards achieving their long-term financial objectives. Understanding the principles of portfolio diversification, implementing asset allocation strategies, and regularly monitoring the portfolio are essential steps toward building a diversified and resilient investment portfolio. Whether through individual investments or pooled investment vehicles, diversification is a powerful tool for managing risk and optimizing investment returns.